Now, fuel consumption in the month of Feb was at its 3-month high. Now, if you see on a YY basis, it increased by around 5.3%, but when compared to month-on-month basis, it was down by around 1 odd percent. Now, this growth on a YY basis was driven by diesel, petrol, and ATF, that is aviation turbine fuel or jet fuel. Now, the diesel consumption in the month of Feb increased by around 7.5% compared to last year to around 7 million metric tons. Petrol consumption was up nearly 9%, while the ATF consumption jumped nearly 43%, and this was on the back of recovery that we are seeing in air traffic in the month of Feb. Now, demand was strong for petrol and diesel despite the fact that the fuel prices have been unrevised and the Brent crude prices have been lower. Now, this is positive for the Indian Oil Corporation, BPCL and HPCL, because these companies are not only oil refiners but also oil marketing companies. Now, the gross marketing margin, if you see, that is what an oil marketing company earns from selling every liter of petrol and diesel. Now, that has increased for diesel to around 0.5 rupees from a negative 7.1 rupees that we had seen in the previous quarter, and for petrol, if you see, it has come down a bit to around 7.8 rupees from 10.3 rupees that we had seen in the previous quarter. But despite this, it is positive because diesel consumption is very high for the oil marketing companies, and on that side, if you see, the margins have turned positive to around 0.5. In fact, if you see the latest margins for diesel, they are trending at around 4.2 rupees per liter, and for petrol it is stable at around 7.5 rupees. So this is positive for the oil marketing companies. Now, a sensitivity analysis shows us that if the blended margins of petrol and diesel increases by around 1.5 rupees per liter, then it positively impacts the consolidated EPS of IOCL, BPCL and HPCL in the range of around 29 to 42%. However, despite this positive, we have seen a decline in the share prices of all the three oil marketing companies in the last 1 month, and this could be on the back of a possible rotation that we are seeing within the energy stocks, because in the last 1 month, though OMCs were down, oil explorers and gas companies were higher in trade. Along with this, the dividend yield or the dividend support coming in from the oil marketing companies have been lower in the last 1 year, and that is because of the losses that they have been reporting. Along with this, there's a weakness in gross refining margins. That is what the oil marketing companies earn from refining every barrel of crude into a refined product. Now, that has declined from around $10 per barrel, the average that we had seen in the month of Jan, to around $7 per barrel in the month of Feb. Along with this, given the fact that general elections are coming in, and even in past we have seen that whenever there are general elections, the marketing margins of the oil marketing companies get compressed. So this is one fear that is there in the street, and the oil prices have continued to remain volatile, which is also one of the factors that have been weighing on the share prices of the oil marketing companies. However, the current news is kind of positive for the oil marketing companies that we are seeing.